Hello, this is Tom Vassallo with MRW Financial Brokerage, and thank you for taking the time to participate in this webinar regarding our long-term care toolkit for annuity advisors. Um, we had an advisor last month when we did this, an annuity advisor that sat in on this webinar, had never sold long-term care. And then he sent out the email and the long-term care planning guide that we provided him. He set his first two appointments in the first week and then held off calling the other people. Closed both of those two sales, generating $30,000 in commission, and he's got six other ones in the pipeline right now. So, this is the type of response we're getting with this long-term care toolkit, and it's designed specifically for annuity advisors, and you'll see why. Let's first talk about the market opportunity in and demand in long-term care. Of course, we have an aging population. By 2030. All baby boomers will be over age 65. Long-term care is really an underserved niche. I've specialized in long-term care for over 30 years now. I used to sell the old traditional long-term care plans, or use it or lose it for long-term care, with a terrible history of rate increases. In 99, 2000, 2001, we saw all the carriers pull out of the market, similar to the disability crisis. We saw long-term care rate increases that every carrier took. And now what we've seen is the birth of the asset-based long-term care products built on either an annuity chassis or a life insurance chassis. But the advisors have not caught up with the products. There's not many people that really understand the products and how they work with your clients. And then COVID, unfortunately, brought a growing client awareness to long-term care with the crisis that you saw in assisted living facilities and nursing homes. And then, of course, as we age, more of our parents are aging, and we're seeing firsthand experience of long-term care. I'd be willing to bet that 70% of my personal business that I had done, we did so, and the people had been through a long-term care experience with their family. So one of the things you're going to notice is we've used many engaging videos to help establish the need for long-term care. Now, I don't know how many of you are familiar with the Washington Long-Term Care Trust Act, or the CARES Act, as they call it. In the year 2000, the state of Washington represented approximately 3% of national long-term care insurance sales. In 2020, I mean, that was in 2020. In 2021, the state of Washington represented 60% of sales nationwide. And here's what the state of Washington did. They gave every Washington resident a $3,000 a month, 1 year long-term care benefit. Now, they needed to fund that some way, and they funded that through an additional payroll tax. But they gave residents of the state of Washington the opportunity to opt out of that benefit and not have to pay the tax if they owned qualified long-term care insurance. So that dramatically increased demand for long-term care sales in the state of Washington. There's currently four states that are moving forward with similar legislation: California, New York, Maryland, and Pennsylvania. None of them have passed yet. And there are other states in early discussions of this. Think of it as the Affordable Care Act, where if you don't own long-term care insurance, you're going to pay a tax penalty. If you do own it, you can opt out of that additional tax. Now, we still have to see, what these states end up implementing. But I think the trend is clear, is that states are going to encourage people to purchase long-term care insurance. They can only do that through additional taxes, because they have to pull some of the pressure off of the Medicaid rolls. Now, let's talk about the product appeal and innovation. Um, First of all, with the asset-based long-term care plans, it allows them to repurpose an existing asset, maybe an underperforming asset, and leverage it for long-term care. If they want, they can keep the money completely liquid, and if they don't use it for long-term care, there's still a death benefit that goes on to their beneficiaries. So we're not talking about these use it or lose it policies anymore that we used to talk about with the traditional long-term care policies. And we also have flexible ways to fund it, anywhere from a single premium where your funds stay completely liquid, you can get them back at any time, or a pay to age 100 premium that you can pay on a monthly basis. Now, here's what's nice about the new flexible premium policies on the asset-based plans. For many of them, everything is guaranteed. You're never going to have a rate increase on these plans, so you don't have to worry about that. What's the revenue and growth potential in it? First of all, it is high value premiums. I mentioned those two cases that annuity advisor, the first two cases he sold generated $30,000 in commission for him. It also creates a tremendous cross-selling opportunity. You have many people doing annuity workshops, not as many people doing long-term care workshops. And to be honest, I'm not a believer that anyone should purchase a long-term care policy that covers 100% of the projected expenses. So, to really help them drill down and to determine the design of their long-term care policy, you need to get into more of their retirement plan. Where's their income coming from? What are their expenses? Because remember, long-term care is not an asset problem, it's a cash flow problem. So where's your current income coming from? What are your current expenses? And how are you going to fund an increase in those expenses if you have a long-term care need? Well, if someone has an annuity that you offered them that has a guaranteed lifetime income and maybe an income doubler for ADLs, you can possibly pare back a little bit the long-term care benefit versus if they don't have that annuity, you'd have to sell them a more robust long-term care benefit. So it leads right into cross-selling opportunities. I've done another workshop on how investment advisors can use long-term care as a wedge between a potential client and their current financial advisor. I've seen too many times where a retirement plan is developed and they've run the Monte Carlo simulations. There's a 97% success rate, but as soon as we model a long-term care loss in there, that success rate drops to 50 or 60%. And it creates repeat and referral business. We get referrals for long-term care. I've gone through many times where we've sold it to one family member and siblings start purchasing policies across the country because there just aren't many people that really understand long-term care. There are significant tax advantages for them. If you have a client with an existing non-qualified annuity, you're going to see we can set that up so they can access it income tax free and not pass that deferred tax liability onto their beneficiaries. Of course, long-term care gives them control and choice on where they're receiving care. And what is it really about? These plans used to be called golden care, things like that. Now it's called asset care because it's about protecting assets. It's about protecting retirement and it's about protecting a legacy. The biggest risk for someone is when I'm married and I need care. My wife is still wanting to maintain a healthy, robust lifestyle, retirement lifestyle, and all of a sudden my care has increased our spending $10,000 or $12,000 a month, and we're seeing assets go on the door, and we can't reallocate a lot of our current cash flow because she still has a lifestyle to maintain. What are some of the challenges when it comes to long-term care? First of all, clients' misconceptions and denial. Many still believe Medicare pays for long-term care. They don't understand the difference between Medicare and Medicaid, or they start worrying about long-term care, talking about with their family and their children, say, don't worry, mom, don't worry, dad, we'll be there for you, having no idea what that actually means. They also look at the history of the traditional long-term care plans that were use it or lose it, have a terrible history of rate increases, and don't realize there are other options out there. And there's an emotional disconnect. As I told you, 70% of the people that have purchased from me did so because they saw a long-term care event in their family. They saw their parents go through it, their grandparents go through it, an uncle and aunt. They saw firsthand that Medicare is not there to pay for it, that you have to spend down your assets to Medicaid, and that does a very good job of impoverishing people. Well, if you haven't been through that, there's an emotional disconnect. And what we've tried to do with this long-term care planning toolkit is utilize videos to help make that connection for people that haven't been through it with their family. What's our goal with the long-term care planning toolkit? It's to empower you as an advisor to confidently present asset-based long-term care solutions with MRW Financial here as your backup. help communicate and accelerate the decision making to your clients, and overcome educational barriers and client misconceptions. And what we also want to do is we really want to differentiate you as an advisor in the retirement planning market because you have that knowledge regarding long-term care. Now, with all of that said, here's how the toolkit is worked. First of all, we have a training platform. We're going to email everyone after this a recording of this webinar, but also a login to the training platform. The training platform is going to go through this process that we've put together. And what I've done is taken the process that I've used for the last 30 years and refined over 30 years and reduced it down to provide you the tools and the guides. You know, the first meeting with someone, I never bring a quote. I know they're interested in long-term care. You're going to see our long-term care planning guide in a minute. We use that as a call to action in marketing, but I want to send that to them, and I also want to use it as a guide in that first meeting. I have to establish the need for long-term care before I start talking any dollars. I have to understand what their pain points are and what their ability to fund a long-term care planning solution is before I present any solutions. So you'll see one of the things I do is an assisted long-term care sales process, essentially field training, if you will. On your first two sales, I'm happy to jump on as your back office long-term care planning specialist via Zoom. No split in compensation or anything. You receive all of it. And take your clients all the way through the process. I don't care if you have full underwriting information, if you have their ages and everything. We're not going to present a solution in that first meeting. We're going to establish a need, and we're going to require something else. You have to have, if you have a married couple or domestic partners, you have to have them both there. They have to play off of each other, and you'll see why. So we do that initial long-term care discovery meeting. You get some information over to me. I'll prepare a long-term care planning summary, product recommendations based on where they live, the cost of care, how long it is until they're going to need care, and we'll present, do the product selection and prepare long-term care planning summaries that, again, you'll see are video assisted, that you can share with your client in that next meeting. In that next meeting, that planning summary meeting, you're not going to share the actual illustrations with them. You're going to use that as planning summary to narrow down the options, leave that with them, and you're going to set up the third meeting. And the third meeting is, all right, Mr. and Mrs. Prospect, when I come back, I'm going to have the illustration that we discussed. Think of all of your questions. I'm going to diligently answer all of your questions. We'll review the illustration. But one of the things you'll see I mentioned in the first meeting is long-term care planning is about creating leverage. We create leverage through your health. We don't know if you're going to qualify for these, so it makes sense to submit an application. You don't have to submit any money with the application, but have you go through the underwriting process and make sure that you can even qualify for these plans. That's going to help you root out any objections that they have. You have that plan refinement meeting, and the answer the questions, get the application in that third meeting. Then we come back in the fourth meeting once they're through underwriting for policy funding and policy delivery. So here are the tools that we've provided in our long-term care planning toolkit. Of course, you can set up as many Zoom meetings with me, or you can pick up the phone, call me for any coaching. But we did put together a long-term care training platform. We'll email you a login to have access to that. All of this material I'm about to share, we will brand for you with your contact information. But there are 3 modules here that are required. It take you about an hour. There are 3 modules that you must watch. So you know how these tools are intended to be used. Then there are other courses in here that are more topic specific. If you have a client that has a non-qualified annuity and we want to take advantage of the Pension Protection Act, for example. If you have a client that's a business owner and they want to tax deduct the premiums. So there are other video modules in there that are optional and you'd use on a case-by-case basis. Sort of the backbone of what we put together is this long-term care planning guide. And we will, once again, brand it with all of your contact information. We'll develop one for your area of the country. We have to do it by metropolitan statistical area. The only difference is what the cost of care is in each one of those MSAs. We'll create as many of them as you want. If you want to do it at a state level or a national level, we can do that as well. This is a great call to action. We have some emails designed that we can get you that you can send out to your existing clients. If this is Tampa St. Pete Clearwater. So in this email, the call to action is to download the Tampa Bay 2025 Tampa Bay Long-Term Care Planning Guide with its 18 integrated videos to help understand, the planning need for long-term care. And then, of course, you're going to follow up with everyone that downloads that and requests that planning guide. They're raising their hand telling you, I'm interested in talking more about long-term care. That's what you set those appointments from, as did the gentleman that was in this webinar a month ago. Now, I always send this to the clients before that first meeting, but I'm also using it as a guide in my discovery meeting. So I'm going to show you how I sort of go through this discovery meeting. The first thing I'm going to ask when I sit down after small talk with the clients is, why are we sitting here today? Why are you interested in long-term care? And what I'm trying to find out is what their personal experience is. Do you have parents that have gone through it, uncles, aunts? And if they do, I'm going to ask questions about it. What was the condition? How long did it last? How did they pay for it? And a couple of things. I need to freshen up that. I need to pull the scab off and freshen up that wound a little bit. You only motivate people into motion by exciting them or disturbing them. And unfortunately, with long-term care, it's disturbing them on what a long-term care event would look like to them and their family. Let's assume, though, you've got someone that just said, I'm looking at it, but I've never had a long-term care event in my family. Well, we need to make that real, and that's what this first page is. And everywhere you see a QR code here, that is a video that they can click on, or if you print it, they can scan it. Now, this video here plays a story. They're only 1 to 3 minutes long. They're short videos. I'll show you one a little bit later during this webinar. But, this one tells the story of when mom starts caring for dad. Then the kids come home for the holidays. All of a sudden, they realize mom's overwhelmed with dad, so they bring in some home health care. As dad's condition progresses, he may need to go out into assisted living, maybe a memory care unit, then eventually more end-of-life nursing home at a skilled nursing home. And now that dad's gone, who's going to be there to take care of mom? How are the assets being spent down as we're paying for all of these expenses? So it starts to make it real. It tells an emotional story. The next portion is, you've got a lot of people think, I'm not going to need care. I don't care if you're a married couple and over age 65. Can we agree that a long-term care event's a cash flow event? It doesn't matter if I need care or if my wife needs care. It's going to have the same impact on our retirement plan. Well, for a married couple over age 65, there's actually a 49% chance that both myself and my wife are going to need care. There's a 42% chance that only one of us will need care and not the other. Either one of those is going to create a negative cash flow event or increase our expenses substantially. There's only a 9% chance that neither one of us will need care, which means, of course, combined, there's a 91% chance that one or both of us will need care. For an individual, it's a 70% chance they'll need care, 30% chance they won't need care. So we want to convince them there's a high likelihood they're going to need long-term care. And of course, we have videos, that help do that. A lot of times when we're talking about long-term care, they're going to engage with their children a little bit, especially the local child. They may talk to their daughter that's local and explain to them that we're thinking about planning for long-term care. And the children are great. They love their parents. They were raised by their parents, and they raised their hand and said, Mom, Dad, if you ever need anything, I'm here for you. Well, understand there's a difference between put it this way. When I need care, yes, I want to spend quality time with my children, and if I have them, grandchildren. I want to spend quality time with them. But I don't want my children's last memory to be bathing me, dressing me, and toileting me. I don't want my child's last memory to be helping me change my diaper. I want to hire a professional for that, and I want to spend quality time with my children. I don't want to put my children in a situation where they're having to take care of me, raise their children, and work. So that's what this is communicating. It's not that your children won't be there for you. They'll sacrifice anything for you. It's that you don't want to put them in that position. And then we've got to talk about the cost of care. for long-term care. And this is just what's different for each area. This is Tampa, St. Pete, Clearwater. That first column there that is just long-term care in 2025 is $80,230. What that simply is the average of someone moving through informal care, home care, assisted living, and nursing home. Assuming someone starts off and moves that whole care continuum, doesn't just spend all the time in the highest cost nursing home. Of course, the cost of care today it's going to increase. So we assume the long-term inflation rate of 3%, and in 20 years, that 80,000 is going to go up to $144,000 per year. What happens if all of a sudden, 20 years from now, I need care and we need to increase our spending $144,000 a year? That's why long-term care is not an asset problem, it's a cash flow problem. And we want to understand that this is a cash flow problem. And the way we illustrate this is we ask them. Now, by this point in the conversation, I usually see one of the two spouses that's sort of dominating. I know which, I can typically figure out who's making the decisions financially. And I'm going to ask them, I'm going to say, now, if one of you needed care yesterday, I'm not directing this question to one of the spouses to the other. If one of you needed care yesterday and we had to start spending $10,000 a month, you have these different buckets of money, for lack of a better term. What's the first bucket you're going to? Now, the person that's controlling the money is usually going to speak up and say, well, we're going to go to the cash equivalent. I don't care if it's the husband and wife. I don't care who it is. I'm going to stop them right there and say, no, 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 no. You're the one that needs care. Which bucket of money are you going to first? And what I want to illustrate is that without a plan, you're leaving these decisions at this time of crisis to the spouse that may not be the best equipped to make these decisions. All right, once I get past that point, okay, so you've got 200,000, you have CDs, an emergency fund. How much do you have in those CDs? We have about $200,000. Okay, that'll get you through about 1 year of care. Those CDs are gone. What does that mean to your healthy spouse? Well, that's okay. We can live without the emergency fund. Okay, what's the next bucket of money you're going to? Okay, we're going to retirement accounts. Now, each one of those has a QR code and you can click on it and it's going to talk about the costs and consequences associated with liquidating those funds to pay for long-term care. For cash equivalents, it's just it's a dollar for dollar liquidation you're spending down your emergency plan. You get into retirement accounts, well, not only do you have to pay taxes on the withdrawals, it's going to increase your provisional income, which may make more of your Social Security taxable. Because of that increased income, you may pay a higher IRMA tax or Medicare premium surcharge, and it may even kick you up to where the net investment income tax you're starting to pay on that. That's why this is a cash flow problem and not an asset problem. And if you spend down that retirement account, now what does that mean to your healthy spouse wanting to maintain a security lifestyle? There's a couple of things we're doing here. One, we're getting them to earmark some money to fund long-term care, but we're also demonstrating them or getting them to think through what happens if I literally have to spend down these assets. Now we introduce the concept of asset-based long-term care planning. And I don't care if it's an annuity-based product or a life insurance-based product, the concept is exactly the same. We're going to reposition a portion of your conservative assets. That may be that, a portion of that CD, that emergency fund that you have. And when I say reposition your assets, that can be done on a single premium, 5 pay, 10 pay, 20 pay, or a monthly premium that you pay until age 100 of the older insured. So it's however you want to reposition it, we have plans that can do that. But here's what's going to happen. You're going to use your asset first, that little slice that says LTC. You're going to spend that down first on your care. All right, if it was that $200,000 CD, maybe we'll reposition $150,000 of that $200,000. You're going to spend down your $150,000 first. But when that's gone, they all have something, extension of benefits, continuation of benefits. The claim is going to keep being paid, so you don't have to move on to those other assets. And if you don't need it for long-term care, the value still passes on to your children. Now we have some videos down here about the advantages of reallocating cash or retirement accounts or annuities or employment income or retirement income. A lot of people hit age 72, 73 years old. They have to start taking out RMD. They don't want it. Maybe we reposition that into an annual long-term care premium. Um, it talks about the advantages of being able to create that income tax-free cash flow exactly when you need it. Now, the follow-up is long-term care planning is all about creating leverage. We want $1 to do the work of $2, $5, $10 or more. But it's not your money that's creating leverage. We are creating leverage on your money. It's not your money creating leverage. What's creating leverage is your health. So we want to get their health information. And here's why it's so crucially important. We have plans that are guaranteed issue. So if someone has a diagnosis of Parkinson's disease or Alzheimer's disease, a long-term care loss is almost a guarantee in that person. You know, if they don't pass away from an accident or something like that. Um, so obviously, the amount of leverage we can create on someone that is uninsurable is much smaller versus someone that's healthy. Well, if we go to someone that has health problems and show them a fully underwritten plan and the amount of leverage that can be created, and then we have to back off to the guaranteed issue plan, it's not going to look very attractive. But if we start with the guaranteed issue plan, it can look very attractive. So it's important to do that underwriting ahead of time. I have access to all of the underwriters. They usually get back to me same day. You get that questionnaire to me, and we'll run it past the underwriters. One of the things you're putting in there is the city and state where they'll most likely receive care, so we can do some planning on the cost of cares. And I get back to you this long-term care planning summary. And to be honest, we just updated this. This has been the game changer. Looks like the same thing we had before, but it's not. This is specific for your client. In the very beginning, it's going to be the same for every client. In the very beginning, you're going to see all of these videos to help establish the need. Now, I want to just play one of the videos here for you, and it's the one for spouses. They're all similar in the way that they work. I'll give you a quick recap. They're only 1 to 3 minutes long, but you're going to see how they help make that emotional connection for you. Obviously, you wouldn't play this video for someone that was single. The audio is not going to be great. It doesn't transfer great over this, but you'll get the idea.
Would change like this. I love my husband dearly, but caring for him every day is harder than I ever expected. Every day brings new challenges. The physical work is exhausting. Some days it feels like there's no break, no time to rest. And then there's the money. All these medical bills, the cost of care, the medications. I worry about what's going to happen to our savings. Will we have enough? It's not just the physical and financial strain. It's emotional too. Some nights, I feel like I'm losing a piece of myself, that I'm disappearing into this role of caregiver. I realized I couldn't do this alone. Planning ahead for long-term care became the lifeline I didn't know I needed. The fact we spoke with someone that helped us plan ahead for care helps me make sense of it all today and gives me hope. We needed a plan, something that would protect us financially, so I could focus on caring for him without worrying about losing everything we've worked for. Since we have a plan in place, I can care for my husband without that constant fear hanging over me. I can be present for him and still take care of myself. Planning for long-term care isn't just about the future. It's about finding peace in the present. Don't wait. Start planning now. It's not easy, but with the right plan, you can get through it, stronger, together.
Now, here's what's been happening, and this will come off as a little sexist, but in the people I've met with over my 30 years, the wives are the one that want the long-term care plans. They see their friends struggling taking care of their husbands. Us husbands will usually get sick and pass away first. The wives are worried about having to spend all that money on our care, spend down their retirement and their retirement security. And the men are coming along kicking and screaming. In the past, what we did is we left them an illustration. We talked to them about the plan. We left them an illustration to review. All that's showing is costs and benefits, it's numbers. Now what we're leaving them is this long-term care planning summary, and you'll see it's going to summarize the illustrations, but we're really leaving this to review. We have seen a sharp increase in sales in using this long-term care planning summary. We have seen people that bought then give this long-term care planning summary to siblings, and they're reaching out to the advisors about long-term care. So these videos are doing the job. They're all from the person's point of view. The adult children is the point of view of a daughter trying to raise her own children and struggling with taking care of her parents while she holds down a full-time job. The family dynamics is an example where you've got a daughter that lives locally, a son that lives locally, another daughter that doesn't live locally. Unfortunately, caregiving falls unfairly on daughters more so than sons. The one daughter's getting overwhelmed. The other daughter's feeling guilty that she can't help because she doesn't live locally. The son's burying his head in the ground, and it's creating a big rift. And it's told from the children's point of view. The retirement income is told from the wife's point of view as she's seeing assets being spent down for long-term care. So what I imagine is happening is here we are leaving this after this planning meeting. The husband's complaining about the cost. The wife's watching these videos, and it's given her the strength to, demand a plan, or more fortitude to help demand the plan. Some of the other things, the life expectancy. I'll ask people all the time, have you experienced any long-term care event with your parents? No, we haven't. How old were your parents when they passed away? And I find out that they've already outlived their parents' age. Well, life expectancy has increased. Maybe the parents didn't live long enough to lead in long-term care. Cognitive issues are what leads to long claims, and is increasing the need of care. Of course, the likelihood of needing care. Long-term care is a cash flow problem and not an asset problem. Now we get into some of the planning that's specific for them. Now, this example was a couple that lives in Sarasota. They're both age 60 years old. The blended cost of care in the year 2025, which is moving through that informal home health, assisted living, and nursing, is $7,550 a month. But hopefully, knock on wood, we're not going to need care today for these 60 years old. So I average their ages together. I go out to age 80. I compound that cost of care at 3% compounded annually, and that cost of care at age 80 is $13,636 a month. So that's in red because everything now is built around that average cost of care. Now, the average cost of care is probably going to be higher. Number one, because that's not the average. That's the average cost. It's not the high-end facility. It's not the worst facility. But as many people know that have had to deal with assisted living facilities, there's the base cost when you go in. Then they add on for everything. If you have your meals delivered, if you have this done, there's add-ons on this. So this is still going to be a little low. But I'm providing you 3 copies of this long-term care planning summary. One where we're meeting 100% of that projected expense, another one where we're meeting 75%, and a third one where we're meeting 50%. Far too often I talk to advisors that have the opinion, they have someone in New York where the cost of care is $10,000 a month right now, and the client's looking at a $5,000 a month policy, and they say, well, what good is that going to do them? The cost of care is $10,000. Well, let me tell you, I have policies that I sold to people 20, 25 years ago where they're getting $1,500, $2,000 a month in benefit. Didn't buy inflation protection. Yeah, the cost of care today is $7,000, $8,000 a month. Not one of them's mad they're getting that $2,000 a month in benefit because it's helping out. Yeah, they have hindsight that's 2020 and wish they had purchased more now that they're on claim, but they're sure glad they have what they have. So I'm a firm believer in something is better than nothing when it comes to long-term care. Now, we really want to drive home that long-term care is about creating leverage and that it's a cash flow problem. So if you remember that $13,636 a month cost of care down here at the bottom at age 80, the monthly long-term care expense, if the client's going to fund that out of their tax qualified plans, they're actually going to have to liquidate $19,480 a month, pay federal taxes on it, not even accounting for state income taxes, increased IRMA, Medicare premium surcharges, increased Social Security taxes, net investment. All we're accounting for is federal income taxes. Pay $5,844 a month in federal income taxes. to net out 13,636. If they go to their capitally appreciated assets, now we have a 15% capital gains tax, so that's much better. We're only having to liquidate $16,042. If it's that CD, that cash asset, well, they've paid the taxes on that. Little or no tax burden, but it's still dollar for dollar. They have to liquidate $13,636. The whole idea of a long-term care plan is using discounted dollars to pay these expenses. See if we can get up to a 75% discount. Now we're getting into some of the product solutions. The first one I always show is the full liquidity option. Personally, I wouldn't buy it for myself. That doesn't mean we don't sell it all the time. Okay, the full liquidity option allows a client to move money from their left pocket to the right pocket. It stays completely liquid. They can get it back at any time, but it leverages it for long-term care. Now, the total premium for this one, this full liquidity, is $220,697. Now, this is the one where we're meeting 100% of the projected monthly expense. If you showed the one that was 50%, this number would be cut in half. 75% would be in between the two, right? Now, I want you to understand, Mr. and Mrs. Prospect, you're not spending that $220,000 because at any time you can cash it in and get every nickel back. So that money isn't spent, that money isn't gone. It is costing you something. There's an opportunity cost. You would be earning interest on that if it's in a money market or in a CD, and you won't be earning interest on it. So that is your cost. That's what you're paying for this coverage, if that makes sense. Now, for us as advisors, if they cash it in the first 12 months, it's 100% chargeback in commissions. If they cash it in the second year, 13 through 24 months, it's a 50% chargeback in commission. Okay. What are they getting for that? Well, if then neither of them needs long-term care, there's a second to die death benefit that goes on to the beneficiaries of $327,264. By the way, we do these for individuals as well. This just happens to be a married couple. But a second to die death benefit of $327,000. So if you don't use it for long-term care, the value is still going on to your children. If you do use it for long-term care, this is the one that's projected at 100% of that projected monthly cost. It will pay a monthly benefit of $13,636 a month per person. So if you're both on claim at the same time, we're north of $27,000 a month. But it has a combined long-term care benefit balance of $981,000. So the way I like to explain it is you can each draw up to $13,636 a month out, income tax-free for long-term care, but you're drawing off the same, for lack of a better term, joint checking account of $981,000. Now, if one person is on claim, that would last for 6 years. Now, what does that mean as far as leverage? Well, if we wanted to fund $981,000, because that's what this policy is doing, fund $981,000 of long-term care benefits, we'd actually have to liquidate $1.4 million out of tax-qualified plans, pay $420,000 in taxes to get a net of $981,000. For capitally appreciated assets, it's $1.1 million, pay the 15% capital gains tax. For cash assets, it's just dollar for dollar, $981,000. We're accomplishing this for $220,000. You know, that's where we're talking about leverage that we're creating. And by the way, you can get your $220,000 back at any time. So this money's still completely liquid. Now, personally, I believe anyone that's putting their money in here should be able to say, we can set this money, we can take this money off of our retirement table, set it in here, earmark it for long-term care, turn it into $981,000 tax-free for long-term care. If we don't need it, $327,000 goes on to our children, but we don't really need it to pay our electric bill, to pay our property taxes, things like that. So if they don't need that, we can create more leverage. This one we call maximum monthly leverage. This is Nationwide Care Matters Together product. Again, it's a joint product for husband and wife. They have different premium options. So we can do a single pay of $233,000. And if you look, it's actually $10,000 more than the full liquidity option. But you'll see we're getting a $1.4 million long-term care benefit rather than $980,000. It also gives you the option to 5 pay the premium, 10 pay it, 20 pay it, or if they want, they can do a monthly premium until age 100 of the older insured. Again, what we're equalizing is the monthly benefit at age 80. So with Nationwide, their inflation, their 3% compound inflation protection is priced extremely competitive. So we're going to start off with a $7,550 a month. It's going to increase 3% compounded annually so that at age 80, it's going to equal $13,636. The pool of money, or that joint checking account, for lack of a better term, is $1,455,085, which if one person was on claim, that's lasting for 8 years. If they don't need it for long-term care and pass away, there's a death benefit of $271,000. And if you look down here at the bottom, if they were using tax qualified assets, they'd have to liquidate over $2 million, pay $600,000 in taxes to net out the $1.4 million. We're doing that for $233,000 in a single premium. Or, for lack of a better term, you can finance it over 5 years, 10 years, 20 years, or to a paid to age 100. Now, many times they'll speak up, well, what if the husband uses all 8 years of benefit and leaves the wife with no benefits? And that's a risk here with Nationwide, or the prior one with the full liquidity. Well, two ways to respond to that. One is the real risk for long-term care, because remember, it's a cash flow event, is when we increase our spending, say $10,000 a month or $13,000 a month, and we have a healthy spouse that's still maintaining a household and still wants to maintain a long, secure retirement. And we just increase spending 10 to 13, $15,000 a month. Now, once I'm gone, my wife can sell the house if she has to, move into assisted living, independent living, assisted living, memory care, and redirect a lot more of our retirement cash flow to her care because she's not having to support a healthy spouse. So that's one answer to what happens if the husband uses all the benefits. The other is we always show an unlimited lifetime benefit period. This is One America's asset care plan. Again, it's going to be about $30,000 more expensive on the single pay than Nationwide. They have a 5-pay, 10-pay, 20-pay, and paid 95 option, but it's going to have a $13,636 a month benefit per person with an unlimited, a lifetime benefit period. So you can never outlive that benefit. That way you can make sure that the benefit is there for both of them. And if they don't use it for long-term care, $327,000 goes onto their beneficiaries, income tax free. So what we do at this point is, and I can't show that normal column of if we turn this, how much we have to liquidate to get that same amount because it's an unlimited amount. So instead we show some of the longest claims that we've had. By the way, what leads to the long claims? It's cognitive impairments, Alzheimer's disease, Parkinson's disease, those chronic progressive conditions that don't necessarily kill you, but force you to require care for a long period of time. Now, still in the planning meeting here, what we're going to do is we're going to show them the three different options. We had the full liquidity option we talked about. Get your money back at any time. You aren't spending it. The maximum leverage option. Yeah, you could cash that in. If you cashed it in year one, you wouldn't get all of your money back. You get it on a single pay, you'd get about 40% of your money back. But there's still the death benefit that goes on to your kids and the robust long-term care benefit. So if you feel comfortable setting your money aside and saying, but for long-term care or passing it on to my kids, we're really not going to need it, then this provides much more leverage. And then there is the lifetime benefit. I'll tell you who in general purchased it. The full liquidity option is purchased when the husband or one of the spouses is really resistant to care. They like the ability to bail out. I've had two cases that I've sold the full liquidity many more times. I've had two cases that I actually thought it was the best fit. One was a couple from New Zealand. They were University of South Florida professors here. They weren't sure if they were going to retire here in the States where they were responsible for paying long-term care, going back to New Zealand where there was state-paid care. They wanted the option if they went back to New Zealand to cash the policy in, get all of their money back. Made all the sense in the world to me. The other one was a second marriage. Now, second marriages are great because on a second marriage, they've probably kept their estate planning documents separate. They probably have a prenuptial agreement going in. They've probably done everything they can to make sure the assets they're bringing into the marriage are going to their children from their first marriage. Well, what they don't want to happen is to watch, the inheritance be spent down on their parents' new spouse's care. And that's what happens with long-term care. Doesn't matter if there's a prenup agreement. Doesn't matter who owns the asset in the marriage. All assets are looked at jointly. So I had a gentleman that purchased a policy, purchased one on himself, purchased one on his wife. We didn't, or new wife. We didn't do a joint policy, and he did not get the return of premium on himself. He did get the return of premium on his wife, and he explained it like this. Quite honestly, he wasn't sure the second marriage was going to last, and he was the owner and beneficiary. She was the insured. He wanted the ability to cash it in if the second marriage didn't last. But typically, that full liquidity option is when one spouse doesn't really want the plan. They're coming in kicking and screaming. The other one does. It gives them the ability to bail out. And I'm a firm believer that that option is better than nothing. Something is better than nothing. Younger people are usually going to purchase the maximum monthly benefit option, the center option. That nationwide product is the younger you are, the more competitive you are. And then people that have been through a cognitive impairment with a family member or seen a long-term care confinement, they're willing to spend a little bit more money for that lifetime benefit. Then we zero in on how do you want to pay it? We can single pay it, 5 pay, 10 pay, 20 pay. People that are still working, what seems to be popular is if I've got 10 more years I'm going to work, let's do a 10 pay so I'm paying it off and not carrying this expense into retirement. My parents are retired school teachers. They have a guaranteed increasing pension for the rest of their lives. They were fine with the paid in 95 option because they have that guaranteed lifetime premium or income. Some people that are retired would rather move money from the right pocket to the left pocket and just single pay it and be done with it. And then finally, we try and determine, how much do you want to shift to the insurance company? Is you want to do the 50%, 75%, 100%, somewhere in between. A lot of times we'll get a thing, well, show me what $100,000 in single premium will do on the nationwide plan, or show me what $10,000 a year for 10 years will do on the nationwide plan. Now we get it narrowed down to one, maybe two illustrations that we're going back to sharing with the client. Make sense? Now, we've put together some other one-pagers tools for you in this toolkit. And again, all of this can be branded with your contact information, and all of them have the built-in videos that we talked about. This is a great one for someone that doesn't understand Medicare, Medicaid, the difference, who pays, what Medicaid spend down is. If you qualify, if you have to go into a nursing home and you're an individual, you're only allowed to keep $2,000 in assets and $30 a month of your income. The rest all goes to your care. People don't realize that. And of course, there's the videos to cover it. And it talks about Medicare, that Medicare will pay the first 20 days if the care is skilled in nature, rehabilitative in nature, and there's 3 days prior hospitalization. After day 20, days 21 through 100, there's a $200 per day copay. Medicare never pays beyond age 100. If Medicare doesn't pay, your Medicare supplement doesn't pay. This is a great tool for someone that wants to self-fund care, that thinks it's not worth it. It helps communicate the problems with self-funding care. Talks about the future long-term care taxes that some states are proposing. Talks about tax exposure risk. Why would you want to liquidate capitally appreciated assets that have a free step-up in basis upon your passing? If you sell it to pay for your care, you have to pay capital gains tax on it. Why would you want to lose that step up in basis? Talks about sequence of return risk. I was doing a lot of retirement planning in 2008, 2009, trying to get clients to look at guaranteed lifetime income annuities. A lot of them wanted to stay more aggressive and keep chasing that return. 2008, 2009 hits, all of a sudden they have to postpone retirement for 4 or 5 years because once they start liquidating that money, and they're having to liquidate more shares to get the same amount of money. They don't own the shares when it recovers. We all know the story. Well, guess what? Long-term care, we can't postpone a long-term care confinement for 2 or 3 years. We start liquidating that money and it just decimates a portfolio. Chances to leverage business income. We build plans all the time where they can deduct 75, 80% of the premium that's going into it. And unlike disability insurance, they can deduct the premium that's going in and the benefits stay income tax free. And then if someone has trusts out there and trust assets, we can really do some more advanced planning with trust assets. Let's touch briefly on the Pension Protection Act. This is a great opportunity, especially for annuity advisors. If you have clients with a non-qualified annuity, say they put 100,000 in, it's grown to 200,000. They've got their income from an income annuity, Social Security, maybe a pension. It's the type of client that's mad they have to take RMDs, right? Because they've got enough income coming in. Well, of course, a typical annuity is last in, first out taxation. So if it put in 100,000 in cost basis, it's grown to 200,000. The first 100,000 they take is taxable to them. Let's say at 24%. So they have 176,000 net out of that annuity and pay $24,000 in taxes. Unfortunately, I see all the time where people are liquidating cash to pay for long-term care, preserving this non-qualified annuity, passing that non-qualified annuity along with the deferred taxes onto their children. We can 1035 exchange this into one compliant with the Pension Protection Act. It does not matter how the current annuity is titled, if it's in the husband's name, wife's name, who the owner, who the annuitant is. Doesn't matter. They do have to be married because of the tax laws regarding spousal continuation of annuities. But as long as they're married, we can 1035 exchange it in. Let's assume the husband's the owner, the husband's the annuitant. We set that same structure up on the new annuity. But the husband is also on this annuity. It's something their other annuity didn't have. It's the husband's the first insured and the wife is the secondary insured, even though she is not an owner and not an annuitant. And the wife is 100% beneficiary with spousal continuation rights. Now, here's what happens. Here's the leverage it creates. By the way, the particular annuity I'm thinking of right now is crediting in 6% interest. There is a rider fee based on how old the individual is. It's 6% interest on $200,000 or more, 5.5% if it's under 200,000. And whatever it grows to, the numbers will triple based on what the value grows to. But let's assume they put it in and they go on claim day one. Here's how this annuity and the taxation works on this new one. And the easiest way to remember this is it's there to benefit your client, not their children. If they use it for long-term care and this annuity is compliant with their Pension Protection Act, the first $100,000 that comes out is the tax-free return of their cost basis. Once they've returned all of their cost basis, the $100,000 of taxable gains also comes out income tax-free for long-term care. Once they exhaust their annuity of $200,000, in this case, there's an additional $400,000 that comes out for long-term care income tax-free. So they immediately turn the $200,000 in that has $176,000 of net after tax value for long-term care into $600,000 of tax-free long-term care coverage. Product still earning 6% interest. Yes, there's a rider drag on it, but it is a tremendous plan. It's taking an asset that they're probably never going to touch that's become an inefficient legacy tool. Let's position it so you can get to it income tax free for long-term care and preserve other assets like cash assets or assets with capital appreciation that have a free step up in basis that are more efficient to move on to the next generation. Let's talk about individuals with pass-through income, S corporations, LLCs, partnerships, sole proprietorships, they own Airbnbs, whatever it is. You have a couple in their 60s. They can deduct $4,810 of that premium per person. So now we're north of $9,000 of the premium tax deductible each year. It's an above-the-line deduction. On Schedule 1, line 17 is a self-employed health insurance deduction. C corporations, if you run into a closely held C corporation, we put together a long-term care deal where a gentleman was a retired doctor. His real business was he owned a lot of commercial real estate, Sam's Clubs, big box stores that he rented back to the stores. All three of his children work in the business. He's in his mid-80s. His wife has Alzheimer's disease with 24-hour round-the-clock home health care right now. He sees how expensive long-term care is. So he decided he was going to do a single premium deposit of $200,000 for each kid. A total of $600,000 went into the Securian Secure Care 2 policies. It has a 5-year return of premium. So day one of year 6, that $600,000 that went in, $200,000 for each kid is completely liquid. They could cash it in if they wanted. The corporation got a $500,000 tax deduction for that health expense in that year. The kids own the policies. They had to pick up approximately $33,000 each in taxable income. But like I said, it's completely liquid at $200,000 in 5 years. They have a very robust long-term care benefit and a death benefit there if they don't use it for long-term care. So a great tool. We have something else called, I know it's like drinking from a fire hose here, and I'm here with our training platform with coaching I can give you through Zoom to help you every step of the way. But we also have something called our assisted long-term care sales process or planning process. Most advisors, annuity advisors, are going to pick this up on their own. All right. But for your first two sales or two prospects, I'm willing to be your back office long-term care planning specialist, participate client facing via Zoom every step of the way, every meeting, and really drive the conversation for you, all the way from the initial discovery meeting to policy delivery. No split in compensation or anything like that. All right. You see it twice, you're going to be competent in it. You're going to be able to do it. You get into situations where someone's really getting into the weeds of the plan, or you're dealing with a CFO on a tax deduction thing. I'm always ongoing support, happy to jump on a Zoom call with you and support you in that way. But I'm talking about a meeting every step of the way. After those first two meetings, there are some people, and you decide on a case by case basis. There's some money managers, there are some property and casualty agents that really don't ever want to learn much about long-term care. They just want to turn over a name, make sure their client's taken care of. They're not going to be in the meetings. I will handle the meeting every step of the way, but in that case, it's going to be a 50-50 split of the commissions. There are other advisors that just don't feel comfortable with it, but they'll be there in the meeting with me, in the Zoom meeting every step of the way. Quite honestly, we're going to have a better closing ratio if you're there in the meeting because you have the relationship with the people and they're looking to you for the service. There isn't a lot of service on these policies. Change of address, that's it, really. They go on claim, they stay on claim. But in that instance, then you retain 70% of the commission. MRW will get 30%. So it's a more robust split to you. You decide on a case-by-case basis. That what I really want to do is get everyone self-sufficient. We're always going to provide the long-term care planning summaries, be there as a backup, can hop on a meeting here or there if you need it. But it's up to you on a case-by-case basis on how you engage in this. Hey, I thank everyone for their time in this. I think you can tell we've put together a lot of tools to really make you successful in this. If you do have any questions, give me a call, 813-875-6331. We're going to send out to you, it takes it a while to process, but a recording of this as well as a login to the planning. Please set up a Zoom meeting with me. The screen you're looking at right now, I think down below you can set up a Zoom meeting. Set up a Zoom meeting. Let's get started. You got to watch those first 3 videos to get the branded material. That's not a big investment. As far as getting appointed and everything, we'll do that when the cases become real. Carriers are just in time. It's all direct carrier appointments, fully vested with the companies, full commission. There's no games. I can let you know what the commission schedules are and everything ahead of time, but carriers don't appoint you to, you submit your first piece of business anyway. Thank you for your time today, and I look forward to working with you. Have a great day.